All right, we're live whenever you're ready. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
All right, everyone. I'm really excited about this episode. We are talking about early investing mistakes, and I have plenty. Not just things I've Googled, but mistakes I've made myself. Chris, do you want to kick us off with an early investing mistake, and we'll just do a little back and forth. I'm sure we have options.
Yeah, like Ben, I am not one to not have mistakes. I also have plenty of mistakes as well. So I guess my first one, and it was a mistake, but I got lucky and it wasn't a mistake, if that makes sense. So timing the market. So I'll just kind of explain this one briefly. So I got extremely lucky when 2019, the market was moving up and up and up and up. So I bought into the market, or at least I made a lot of different, I bought a lot of different shares and stocks in early 2019. And luckily for me, the market basically moved in the upward direction all year long. Right around the point when the coronavirus hit, I was doing things called setting stop losses or stop limits, meaning that let's just do an example. I bought Tesla at $200
Before the split, right?
Before the split.
Yeah.
So I bought it at $200 and it went up to like $470. So then I would set my stop loss or my stop limit to like $440. I was doing like I was using a percentage base. So, 5% below the max. But even if the stock sold at $450, I made $250 on top of my initial $200 investment. And then all of a sudden the stock shot up to 610. So then I stopped my stop loss to 550. Then all of a sudden the stock shot up to, it got as high as 905 or 910. And I set my stop loss at like 850 or 860. And then all of a sudden there's a big market correction and it sold off at like 850. But I made from $200, I made 850. So I made $650 of profit. But I wasn't just doing that with Tesla. I did that with all my stocks. So I was always moving the bounds higher and higher. So like basically, if the stock starts here, it's moving up. I was kind of setting my stop limit like below this. So even if it's sold, I was still making more than my initial investment. Does that kind of make sense graphically? So I did that with all my stocks. I was always constantly moving my stop limit. Then the coronavirus hit. All the stocks dropped into the red and it sold me out of the market completely. And I was all in cash. Like I said, this sounds like a good thing, but it's not. So in a way, I was timing the market and saying that I'm taking my profits. Yeah, I had to pay a lot in capital gains because it was less than a year that I had them. It was the same as the same capital gains tax as, the amount that I was making. But I did make a lot of money, but I was timing the market because God forbid I had fear and was like, oh, I don't want to go back into the market because things are bad, things are this. And then I bought back into positions in May through August or September timeframe. So a lot of my stocks now are doing much better than they were. But in a way, I was timing the market. God forbid, I didn't invest at that time or the market kept going down and I was fearful and never went back in. I wouldn't have gotten the crazy gains. I know Tony Robbins talks about and a bunch of other, big investment people. Tony Robbins' book, Money Master the Game, highly recommend. But he talks about if you miss the top 10 trading days, instead of getting an annualized return in the S&P 500 by around 7%, you'd get more of like 2%. And if you miss the top 20 days, it's slightly negative. And you miss the top 30 days, all like in 20 years or whatever, all time, you like are negative returns. So like in a way, like with me all being in cash and out of the market, yeah, I had my 401k as protection because I was always investing into that. But like in my personal stocks, I got very lucky, and you should never try and time the market and do what I did. So I don't have stop limits on any of my stuff anymore. I just kind of take it as the price goes down. I buy more of what I think is good to get, dollar cost averaging in. So I hope that makes sense.
Yeah, I think that's, and I can roll into my next mistake, but that's a big thing about, setting those stop limit. They are dangerous in my opinion. I would much rather, so there's definitely something to be said about taking out like the emotion out of the equation by setting up some numeric thresholds. But if you're buying a company and you believe in the asset, I think like you should be able to stomach 10, 20, 30% moves on a company. I think there was a figure, and I'll look this up in the background, but there's a figure that like in the 52-week like stock of the low to the high to a stock price, I think it can vary up to like 70%. So the low to high, like the stock will move quite a bit throughout the year, and setting these thresholds where you're like, oh, if it moves, I'm going to sell, or if it goes high enough, I'm going to close out my profits. What you experienced, Chris, is like, yes, there was timing in the market to like get out, but with that $650 profit, you got hit with your 24, let's just say it was 24. I don't know what you make, but that 20, let's just arbitrarily say 24% short-term capital gains tax, which is income tax. On that 650, come tax time, you're losing $156.
Yeah.
So that just makes it so much harder to make a return that's higher than the S&P 500 if you're trading in and out of the market. So if you believe in a company and you're buying at a certain price, the stock will move. So unless your underlying thesis of why you're buying the company has changed, you don't need to sell. I think what we talked about in the prior episode about opportunity cost of when to sell, make sure that your underlying thesis is strong and that there's not a better opportunity out there. Whether you think that that company is overvalued, what have you, that's a different story. But just setting arbitrary limits, again, timing, just be careful with doing that. I think that kind of answers what one of my early mistakes was just like lack of patience. I think that's what I want to talk about is just not having patience in the market. When you are introduced to investing for like the first time, I think with like social media and just like accessibility to information, I think there's this latent expectation that you're going to make a lot of money pretty fast in the stock market. I think you can, and most likely if you stick to a good strategy and you're intelligent about your decisions, you will make a lot of money in the stock market if you just have a consistent strategy. You're consistently investing, like Chris said, with dollar cost averaging. But the time scale of investing, you need to extend it into thinking about in terms of years, not months, not quarters, but years.
Not even days. So even kind of talking on your social media point,
yeah,
there's a lot of day traders. I see them all the time on Instagram because I talk about, trading and investing and all that. Yeah, or Reddit. But a lot of times they'll be like, hey, like I'm a day trader. I'm a swing trader. I make 2% a day, where some people are just trying to get 2% a month. I make 2% a day, trading shares and all that. I looked up the numbers. So only 10% of day traders make money, where 90% lose money, because exactly what Ben's talking about. You're penalized with trading in and out of the market. You're taxed on those capital gains. So you need to make even more. The stat was saying, really, it's not like you need to be better than 50%. You need to make 60 to 70% more money, because with taxes and all these going in and out, the cost of going in and out, the friction of that, you lose a lot of money from that. But yeah, I think a lot of those people, I've never heard of a day trader that's a billionaire. Just think about that. I've never heard of a day trader that's a billionaire. If you look at Warren Buffett, he was really a long-term investor, and one of his, statutes or ideals was buy a company to hold forever, and he's a billionaire with a B. So I've never, there's many of these day traders that are like, oh, I'm a millionaire. It's like a lot of times it's kind of a sales pitch to buy their course, and that's how they became a millionaire. They became a millionaire because you're buying their course. They didn't become a millionaire because they're day trading all the time.
Yeah, that's even a point I had in my notes was like, when you're buying a company, and like this is my mantra, and I think Chris, you subscribe to this too. When you're investing, you're buying a business. This is something that, it's as if you just invested in a franchise on Main Street. Like I'm now the owner of a Dunkin' Donuts. Like you don't want to just own that store for 5 days because you didn't make much money. You already put up you made the time to make the investment. You went through the process. That's sort of similar how you should be thinking about making your investment decisions, is like, what is a business I just want to own that I can trust, that I don't even need to look at my investment account. I think this is something we always quote Warren Buffett. But if the stock exchange, or maybe it was Benjamin Graham, if the stock exchange were no longer reporting numbers for the next 5 years, what are the companies you're willing to own? And then you're not even worried about it.
Yeah.
I think really the point I kind of want to make on that in terms of like patience, just to wrap up my point, is the reason why stocks go up is because the market hasn't fully appreciated what the value of that business is.
Mm-hmm.
So I think by definition, you need to give the market time to react and value your business. If you think that the business is undervalued, but the stock hasn't jumped 1,000% today, that's fine. That gives you a chance to buy more tomorrow or next month or next year. You owning a company, the goal should be that's still a great company to buy in 10 years. I think that's the way to think about that. We talked about the punch cards. I think, Chris, you brought that up.
Yeah.
Buy the best businesses that you possibly can. And if you're buying the right businesses, it will go up. And at the end of the day, the goal is to not lose money. So if your odds are 90% you're going to lose money by day trading, I wouldn't like those odds.
Yeah,
so
think about in terms of gambling, 90% you're going to lose money. That would be a horrible game in the casino, and there's plenty of games in the casino that are like that. And one last point. I know we love quoting Warren Buffett here. Warren Buffett, one of my favorite quotes. It seems all of them are my favorite quotes, but one of the best ones that are analogies he uses is: imagine you buy a house for $200,000, and all of a sudden, like a week later, someone says, "Oh, the housing market goes down, and your house is only valued at $180,000." You're gonna be pissed that you're like, "Okay, I kind of overpaid for it," but you're not immediately gonna go out and sell your house and be like, "Oh, well, this is a crap house. I don't want to live here." The same goes for if it goes up. If you buy your house at $200,000, and then next week it goes up to $220,000, you're not like, "Oh wow, like I got an extra $20,000 in equity in this house. I'm gonna sell the house and buy a new house that's even bigger," because at the end of the day, there's all the frictional costs of you need a real estate agent. You have to pay the broker. You have to pay the movers. You have to pay all this. And then by the time you move into a house that's now $220,000, the market fell back down. That old house that you're in was $200,000 over that short time span. And then it's like, okay, well, I just spent another $6,000, $10,000, $30,000 just to move from one house to a slightly bigger house that's more expensive now. So, what the people, when they get a lot of value out of their houses, is when they stay in them for long periods of times. Obviously, we could talk about real estate investing where you buy a house and you're renting out a property. That's a different scenario. But like in terms of when you invest in a house that you live in, a lot of people recommend that you stay there for much longer than, a short periods of time moving in and out of different houses.
Yeah, and the value is in the time and in the security of you are storing money in this equity that by your analysis, your thoughts, it will grow. The difference is like your house is providing you shelter, or if you're renting it out to people, you're getting sort of fixed income, which is similar to a dividend in the company. But like there's just a danger to be aware of where buying a stock, it is so easy to do so nowadays. You just click a button and you are done. And then to do the same to sell it, you click a button and then you're done. But there's nothing in Robinhood, there's nothing in Charles Schwab that when you click sell or click buy, that it is going to calculate the tax. And the tax is such a sneaky little bugger that you won't notice until tax season. And it feels like it's not even there. It feels like it's more of an apparition tax on capital gains. But every time you make a buy or a sell, the IRS is tracking it. And when it comes time, you can bet your bottom dollar that they are going to take your bottom dollar on whatever you own capital gains. So that's something you really got to think about, is what is the next best opportunity, but what does this sell cost me? It's just something to be really aware of, is when I'm making a trade, both buy and sell, I think especially on the sell side that gets ignored, is how much tax will this cost me? And if you're not thinking about that, then you're missing a mark, because when you could be getting a lot of this upside, you could just be going flat or down, and you're losing to tax, not because of bad decisions in the market, but just by bad tax allocation. So that's a big one. We don't like tax here.
We don't. Legally avoiding tax is a great thing.
It's a great thing.
Illegally avoiding tax, bad thing. Don't do that. Taxes, you still have to pay them. They are good for society, but legally avoiding taxes is a good thing. And by legally, it means the government set up these rules to allow you to, like, incentivize you to do certain things. So that's what we're here on the Amateur Investors Podcast. Ben, if you'd like to give me another mistake that you've made.
Yeah, I think so. I think this will be a quick one because we sort of touched on it already. I've got one that I really want to dig into after this, is remove emotions from investing. Like, again, I know we talked about this I think in the prior episode about sort of like the psychology of investing, this like reward versus consequence, sort of like conditioning that we'll see. When you see like the green and you're making money, you get a flood of just hormones that you are excited. You're getting dopamine, serotonin, what have you. That feels really good to make money. But when you're losing money, the opposite happens. Anxiety hits. You start to get, cortisol, the stress hormone.
Yeah.
That when you're losing money, those hormones are flooding. And I think those are not something to ignore, but they are an opportunity to learn. And if you're not learning from those mistakes when the market's going down, or if you sold at the wrong time, or you're being emotional, one, remove emotion, but learn from the mistakes that you make as well. But I think removing emotion is key. Don't fall in love with your company because, one, you're not the CEO of that business. You are the owner and investor of a business. So don't fall in love with them. Let's say something fundamentally has changed about the business where, let's talk about Nike. They're no longer making clothes or shoes. They're now getting into concrete. I am a Nike investor. I'm not a Nike. I don't own shares of Nike. But as a Nike investor, do I really want to stay in Nike if now they've changed the fundamentals of that business? It's like, oh, well, I love Nike. Nike's always been so cool. Don't fall in love with the business because now the business has changed. And I think that was a really far-fetched example. But you need to be ready to change your decision and admit that if you were wrong when something changes. And that's okay because you're not the one making the decisions. You're not the CEO. You're not an executive. You're not an employee of this company. You just need to be making sure that your fundamentals of this business are still intact. And when that changes, I think humility is a big thing, and just make a decision, because the faster you can make a change off of a wrong decision, the faster that you can get back into making right decisions. Yeah. So don't fall in love with your business. And Chris, feel free to jump in, but I think the last point I kind of want to make on this is sort of the opposite end of the spectrum is when the company goes down. I think stock investing is looked so much differently than, let's say you're walking to Lululemon and you're trying to buy, some workout clothes right before the holidays. Let's see, there's a clearance sale in Lululemon and there's 75% off leggings, 75% off of windbreakers, whatever. I don't know everything that they sell. Their boxers are very comfortable though. I will give a picture of them. Who gets upset at a clearance sale for your favorite store? You go in there, you've got, $100 to go buy whatever you want. You can bet your bottom dollar I'm going to the clearance rack. I'm going to go to find the sales. I'm going to use my coupons. Why, if you're buying a good company as a stock, why, if the stock goes down for no other reason than it is going down, would you sell? At the end of the day, if you believe in this business, like we were saying before, like you need to believe in your business, and you need to understand the business. If it's going down, but you still believe in this business, well, that sounds like a great opportunity to buy more. The market has these clearance sales, these flash sales, and they're called corrections, they're called depressions, recessions. But again, these moves in the stock market are opportunity. Whether it goes up, that's an opportunity to sell. If let's say that's what you decide to do, and when it goes down, it's an opportunity to buy more if it's still a good business. So those are just things to be aware of.
And, I know Ben and I both capitalized on the market going down with the pandemic. We were able to buy more better businesses at cheaper rates. It's exactly like Ben was saying, kind of the stock market was on sale. Warren Buffett, he always says that, like, a lot of times when people are being fearful is a time to be greedy. And when others are greedy, it's a time to be fearful. Right now, we're hitting all-time highs in the stock market. This is kind of a time of extreme greed. You should kind of be a little fearful. And I kind of am. But, when the market went down a lot because of the coronavirus, it was a correction or an adjustment. We had to cope with living in a, coronavirus world or a pandemic world.
Yeah.
And the businesses adapted and, hopefully are surviving. But the ones that are doing very well. So yeah, I think, removing the emotions is a big part, and a good point that Ben has there. So I guess one of my investing mistakes is kind of getting pressured into investment. I kind of see this as like a sales trap. Like I said, I do a lot of investing research, a lot of late nights, and I'm like everyone else. In the 21st century, it's a social media age. It's an information age. I'm on Instagram. I'm on Twitter, not only with our business accounts, but our personal accounts. And like I said, since I do a decent amount of talking about investing, I see Grant Cardone Capital, Masterworks, for buying and investing in artwork. I see, day traders, like I said before, running their Instagram ads are like, oh, you can make so much money. I see a lot of those when I evaluate them, like when I step back and look past the sales pitch. And I'm able to, look at the financials, to look at a lot of the criteria they're setting. It's a really good investment for them. It's not necessarily a good investment for you. And that's something that I really kind of want to hammer home for our listeners. It's not to say that they're, evil or bad or anything like that. I think there's a lot to learn from them. A lot of them have free content or stuff that you can even look into. But I think a lot of times when they're trying to trick you into going into one of their investments, even like, let's just go Cardone Capital, for example. The minimum investment's $5,000. So you would invest in them, and they're not a REIT, but they invest in large property real estate. So whether it's a collection of apartment complexes, 1,000 units, 100 units, 400 units. And basically what they're doing is they're buying these multi-million-dollar deals. And then as the rent is coming in from those properties, they're paying you a dividend of 6%, which sounds pretty great, all that. But a thing that kind of made me really weary when I was looking into it, I was heavily considering investing into it. And I had the money. I had to put up, I could put up the money. I could call them and all that. The issue is that since they're a privately owned company, they have the benefit of hiding a lot of their financial statements, income statements, balance sheets, and cash flow statements. And it kind of looked very, I don't want to accuse anyone, but just looking at it kind of seemed very, Ponzi scheme-ish. And like I said, this is an opinion of my own. This is when I was doing my own analysis. I hope they don't sue us or anything. This is just me saying what I think. And, they were doing really well. They have been around since 2013. I think they were allowing, not accredited investors to invest in them. But the market's only gone up. But with the pandemic going on and everything that's going on, the rent freeze potentially ending, end of December 31st. A lot of people with jobs lost. Even though the stock market has done well, I think we are heading into a recession or a depression coming up because of a lot of this, because of the market dynamics. And it was just kind of an investment that I walked away. And, something I always tell myself, the best investments are the investments that you walk away from because you've done enough research to know that they're not good investments. So ultimately, I didn't invest with him. I wish him nothing but him and his business the best, but I'm just really nervous and fearful of what's to come with a lot of potentially getting evicted, not being able to afford rent, and those monthly checks that you might be seeing might all of a sudden diminish and you're not making 6%. You're making less than that. Or, he has your capital and there's even fine print in there saying that they don't owe you the principal that you invested. So I don't know. It was just not a risk I was willing to worth taking. And that's just something with me looking into the market dynamics of it. So sorry, that was a long-winded answer for it.
No, it was honestly a great answer. And I think it ties into what I wanted to talk about next was I think the biggest mistake that I've made and consistently have made and probably will always make is not doing enough research. I think that's really what it boils down to. These stock pitch companies and what have you, like the Motley Fool, whatever, they have a great business model, But the way that I have now shifted away from, as opposed to be like, oh, I got the next big thing, use that as kind of like a filter to get information. It's like, oh, I just learned about a new company that I didn't know about. What that is that's a checkpoint in your research. That is just day zero. I've learned about this company, as in I know it exists. Time to go do research and understand the business. And if you're not a big financial like reader yet, I think that's what we're here for. We want to make, investing as accessible as possible. That's like our goal, is to boil things down for like what's made sense for us to avoid the mistakes that we've made and probably will make, and we'll always come back. I think this is something we can always come back to, is like, what's a new mistake that I've made? Because that's what learning is all about. You don't learn until you've made mistakes, unless you've struggled. But that's what I think our goal is going to be. But a couple quick things. I've kind of boiled down 3 things that if you've never looked at financial data for a company, these are things that I think you should look at. And Chris, add, subtract as you think.
Yeah, definitely.
The first thing that I look at, one, is the PE ratio. And what that is, it's a fraction. It's price to earnings. So we were talking about that money-making machine. How much am I paying to get access to their profits? A good ratio, the lower the better. I know Warren Buffett liked 10 to 15. There are companies that can go up to the thousands. So meaning that if you take the inverse of that PE ratio, that will tell you the estimated, in the roughest of terms, what the return period will be. So let's say the PE ratio is 10. You take 1 over 10, so you can anticipate a 10% return. And that means 10 years you'll recoup that principal that you invested. Mm-hmm. So that's a really key thing to understand, is how expensive is this company. That's always very public. You can see that in any company.
Yeah, and a lot of times, sorry to stop you there, go ahead. But the price to earnings ratio, I will say it's something that you have to compare across sectors. So a lot of times in the tech sectors, or even just, new age tech sectors, I know Tesla was over 1,000 for their PE. So just think about that. So over the course of, what was that? Not 1,000 years, but basically a lot of what Tesla's doing is they're on future earnings. It would be 1,000 years. Yeah. So a lot of what they're doing is basically it's saying that they can't grow me evaluating the business. I love Elon Musk for what he's worth. I think he's a genius. I think what he's doing is incredible. But just investing in Tesla, I did early on, but it looks like it's just going market crazy. And we could talk about that a little bit later. But a lot of the tech sector, they're much higher than that 10 range, because it's based on future earnings, because they're in, whether in an internet company or a tech company, a lot of people are projecting that like they're going to make the next big thing, whether that's AI or, robots that can do a lot of the dirty work that we don't want to do as humans, or whatever that may be. Yeah, a lot of people, it's kind of like, oh, well, they could be the ones to, master AI or whatever that new thing is. Go ahead.
Yeah. And with that, that's a great point, Chris, honestly, because I think it's very easy to like try and refute that. It's like, okay, well, Tesla's PE might be like 1,000 or whatever, but look how the stock has performed. The stock price doesn't mean that it's logically moving.
Yeah.
Right?
Yes.
Like, again, like what Chris was saying, when you have a company that's PE, like Zoom, again, another example of these bubble stocks, those are still fantastic businesses. But at the end of the day, what you're buying are businesses at the right price. And again, if Tesla's a good investment, it should still be a good investment next year. So like, let that company perform. But by making the stock price go up, what you're doing is pulling those earnings from the future into the present, so that the stock or the business has to grow its earnings, 900, whatever, X, 1,000 times to get up to justify that valuation. Because otherwise, there's this principle called reversion to the mean, that sure, the stock price might go up, but at the end of the day, over the long run, all businesses will be valued appropriately. That might not be this year, might not be next year, it might be 5 years, it might be 10 years. But if a company is overpriced, it will retrace and it will go down if it's not right, because the market will be like, okay, these factors that we were guessing and were anticipating, like autonomous driving, let's say Tesla, never capitalized on autonomous driving, and we were going to say that that was a $500 billion market. That's $500 billion off of their anticipated value that is now gone. So those are things to be aware of. That PE is just like a quick snapshot of being like, okay, if the PE is 1,000, might want to look into this and understand what's going on. Otherwise, might want to move on. Secondly, I think that another big key, and I only have 3 things I want to talk about on this one for the research, is the company profitable? If the company's not profitable, then you might want to look for a business that's managing its money a little bit better. There are so many businesses available on the market. So why not pick the best companies? So I would always steer you towards profitable businesses. And then thirdly, are they a market leader? I think this ties into my last point there just before. With your ability to buy any company in the stock market, why would you settle for an okay company?
Yeah.
So those are my 3 things. Are they a market leader? Meaning they have security in their market. 2, are they profitable? And 3, what's the PE ratio on the company?
Yeah, definitely. And then I know for me, my one of my early mistakes is kind of getting told to invest in something because everyone else was. So there's a thing called Tulip Mania, and this happened in the 1600s. It was kind of right when the first kind of stock market was ever really happening. And it was based out of, I'm going to draw a blank. I don't know if it was Denmark or I forget. I'll check the company. I have a bunch of links to the videos, or the Dutch Republic. That's where it was, in the Netherlands. So Tulip Mania, basically, I'll sum it up in a nutshell. Basically, tulips were getting evaluated, and they were kind of being used as as currency and exchange. People thought they were a very pretty flower, so people wanted to buy them. And then at one point, there was a virus, actually, like more of a flower or a floral virus that caused the tulips to have stripes on them. So they were like red, but with white stripes and stuff. And in that, the stripes made them look really pretty colored and very interestingly colored. So with that, people were like, wow, these are super rare tulips. So this was actually the first bubble that people were buying tulips and, buying them. And there wasn't enough supply of tulips to account for basically the stock price or what the price they were going for. At the end of, I think it was in 1637. So at 1630, it was really like the price was about $1,000 francs, I believe they were called. I forget the currency, but basically it was the equivalent of 10 months of wages for a carpenter. At the end or the peak, the wages were, or the equivalent, they translated them to current day prices. One tulip was costing $486,000. So in current day economics, $486,000 for one bulb or one tulip, one flower. It was more than the price of many people's homes in the United States today. And then that's kind of when people were like, this is getting out of hand. And that was when the first crash happened, when someone offered their tulip and he was expecting, this crazy price or this crazy amount of money, and ended up coming crashing down. So it was pretty crazy. I know the most recent bubble or the crash that I kind of saw was in Bitcoin. So back in 2017, I was actually really bearish, or I was very against Bitcoin. And the way that I knew that was people who had never invested before. I had only been investing 2 short years. But I was investing, I was investing regularly in my 401k and stuff, but people who I know who had never invested in their life were like, Chris, you should really buy Bitcoin. It's really good. It's going up. It's going to be valued at that. It was in that moment that I knew that I was not going to buy Bitcoin in 2017. And if you want to look at the charts of like 2012 to 2017, you could see the sharp spike in tail end of 2016 into 2017. And then all of a sudden a steady crash. Ironically, now I am very bullish on Bitcoin for the long term. I am very bullish on Bitcoin.
We should have an episode on Bitcoin.
Yeah, we will definitely will. But back in 2017, the economics weren't there. The market dynamics weren't there. The technology wasn't there. The companies weren't there. The exchanges weren't there. There was a lot of different things for 2017 why I was very against it. I kind of thought it was going to be a phase that was going to come and go and disappear. But now, for the long term, I am a long time buyer, and I will say that with wholeheartedly. I'm, daily cost average or dollar cost averaging into Bitcoin. So I'm using different program and app, and I can share that in the show notes too, to dollar cost average almost like a stock. And I've actually taken a large position in Bitcoin right now recently. I sold some of my investments and I took a large investment into Bitcoin. But yeah, basically that's kind of like what I was saying. Like, there's going to be bubbles, whether it's Tulip Mania, you could look at all the bubbles. There was a stock market, the housing market crash in 2008. Everyone was like, buy houses, buy property, they always go up. And that was the bubble in 2008, in more residential real estate. In 2017, it was Bitcoin. In 1937, it was tulips. So there will always be these bubbles. I'm kind of seeing in Tesla, no shame to my boy Elon Musk or anything, but, there's things that, things will go up a lot. Then there'll be a correction in the market, and then it'll be kind of fairly evaluated, kind of what Ben was talking about earlier. So I think a lot of that's going to be happening for a lot of businesses because the stock market is so high right now. It's just something that I'm always watching and monitoring, but I think that's coming sooner rather than later. So yeah, that's just kind of what it like. If someone's telling you, tulips, Bitcoin, whatever it may be, you just need to do your own research. You need to evaluate. And there was even, I don't know if it was Paul Tudor Jones, a famous economist. There was someone that he predicted a crash in, I think, the 80s, that he was going to get his shoes shined, or he was going to do something. And he was going to get his shoes shined, and the shoe shiner was like, oh, like you should buy like this company. It's only going to go up. And immediately he sold out of all of his positions in the stock market. Cause he's like, when some guy who, has not a lot of money, like no offense to this guy, but has not a lot of money, but he was saying how he moved all his life savings to buy this stock, this whatever. He took out his money, and then 5 weeks later, there was a huge crash in the stock market. So it was just, like I said, that's timing the market, a bad thing to do, but he kind of knew a crash was coming because getting advice from people that you would never take advice from before in your life. So I know that was a long-winded answer.
No, Chris, don't. You never need to apologize for the long-winded answers. Like all we're doing is being long-winded because we're just talking to each other. But the bubble thing is so important because, and I have one last one as we're wrapping up. I have one last mistake to avoid, and I think this could be a segment for us to go back to. Avoiding these bubbles when something feels too good to be true, it probably is, and when there's a trend, you're probably too late. Yeah. And that's not always true, but it's, I think, a cautionary tale that when something is inflammatory and it's so popular, you're late to the trend. Because if everyone knows about it, then everyone knows about it. So the people that have the edge can move the markets, have the money, they're going to not give you the best price because they've already locked in the best deal. So it's just... Yeah. Again, it goes back to patience. It goes back to just wait for that next opportunity, because if there's Tulip Mania, there's going to be another bubble. You're going to have your opportunity to get early on the trend somewhere else.
Yeah. And expanding on that, I know, Robinhood had, they have top movers. I don't know if you always see that on the app. When you open up the app and you scroll past like your current portfolio, right below that, it talks about top movers, and it shows the stocks that have the biggest price moves, whether they're up or down. I am a bigger person than to look into the downward movements. I avoid any of the upward movements. Where this company has gone up 31% in one day, it's kind of like, all right, well, I've already missed the window on capitalizing on that opportunity. Not that I would invest in it even if it was below at that normal price the day before, but I'm a bigger person of looking at the ones that go down. I'm more intrigued by those because I'm like, oh, they went down. Was it a bad quarter of earnings? Did the CEO step down? Are they in a lawsuit? Like, why did it go down? And then maybe this is a point, kind of like Ben was saying, this business might be on 30% sale. They might be going out of business. So I need to evaluate that I'm not buying something that goes bankrupt, but it might be a good time of like, oh, like something happened. Whether it's a Nike, an Amazon, an Apple, a Google, whatever it may be, if Amazon, Google, or Apple were on a 30% sale, a lot of people would be looking at that business like, why is this the case? Is it, a competitor coming up and taking market share? Are they in a lawsuit? Kind of all those things that I expanded on, it might be a time to buy them and, capitalize on them. Like I said, word of warning, it might be because they're going out of business. We've seen a lot of businesses like Hertz or, Pier 1 Imports or various businesses go out of business because of the pandemic and stuff like that. But it's just something like, oh, it's on sale. Maybe it's a good deal. That's just something to look into.
Yeah, and I'm going to jump into the last point after what I'm going to say now. But I think some of the best investing moves that I've made kind of make you feel sick to your stomach because you're like, why would I be more right than most of the market?
Yeah.
But I think in order to win in the market more than just average, is you need to make those decisions that are uncomfortable. I know that there are famous investors. I'm drawing a blank on the names, but I'll pull up an article. There are a couple investors that like billionaire successful investors that every time they would make it a good investing decision, their back would hurt. And like I forget who this was, it's bothering me. But every time they knew it was a good decision, they would physically ache, like to the point where they would take off of work, they would be in bed.
Maybe either John Bogle or Carl Icahn or who's Bridgewater Investments guy?
It's not Ray Dalio.
It's not.
I'll look it up. I would just be guessing. But again, it goes back to that: be greedy when others are fearful. Be fearful when others are greedy. It's bucking the trend and making a decision because you believe that it's right. You've done your research. That's hugely important. It boils down to everything that we said. My last point, which maybe should have been first, is if you are starting out your investing career as, a Webull or Robinhood investor, the first thing you're going to get after you've used someone's link, you're going to get a free share of stock. It is almost definitely going to be SiriusXM or some $3 to $5 stock. Chris, did you get SiriusXM?
I did get SiriusXM.
I got SiriusXM. When you get these companies, the next thing you're going to think about, and I don't want to say I'm a mind reader, but you're going to think, okay, well, I've got $100 or $1,000. Let me go find some cheap stocks. And cheap to you is going to probably mean it's $3 to $5 or less. Please, please, please avoid buying these companies until you've done your research. These penny stocks, which I think are companies below 10 now, I think they're classified as penny stocks. I could be wrong, but we'll always fact check ourselves in our show notes. There's a reason why these companies have gone below the threshold where they're not even just undervalued, they're penny stocks where the market is considering them something different. Cheap doesn't mean share price. Cheap is, again, what I mentioned about the price, the PE ratio, the price to earnings. Cheap is you are paying a little to get access to a lot of profit. Small share price, that share of $3 or $4 still could have a PE of 1,000. If that company is negative, it's infinite because any positive number times a negative number is a negative number.
Yeah.
So my cautionary tale, when you see that penny stock, that free stock, that's a great opportunity to start doing some research on your first company. Maybe that's the first company you look at because you have it. Maybe hold it for a year so you don't get hit with capital gains. I think it might get taxed as a bonus. I'm shooting from the hip on that one. That's something I actually want to know, so I'll look it up. But those penny stocks do not mean they're cheap. I think that's the biggest thing, is thinking you're buying cheap stocks. Cheap stocks, a cheap stock could be $1,000 per share. A cheap stock is you're getting a great price to access to a lot of profits. And that's just the main differentiator of thought, is that these penny stocks, they're probably cheap for a reason. So steer clear of them until you've done your research. So that's my last little tidbit of advice. Chris, any wrap-up thoughts?
No, I think we hit a lot of our mistakes. There's 100% chance I do make more mistakes going forward. So I'm sure we'll do a recap in a few years about additional mistakes that we've made. It's not even a question. There will be additional mistakes I continue to make in investing. That's the only guarantee I can give you guys, definitely.
The stock market moves and we'll make mistakes.
Death, taxes, I will make investing mistakes, and all that. I guess, the last thing to do is if you guys give us a like, a comment, or share this video, or just recommend this podcast to a friend. You can always follow us on YouTube, The Amateur Investors, Instagram, Twitter. We're The Amateur Invis, or The Amateur INVS. We just couldn't fit investors on the for the tag for Twitter. We have a Facebook group. We have a new website, so theamateurinvestors.squarespace.com. Please check it out. Give us, any recommendations, anything we should update, what you guys think of it. That would be great. Thanks for spending time with us. Ben, if you have anything else you want to add there.
Yeah, I mean, like Chris said, just drop us a line. I think what we love the most is getting feedback from our audience. Like, whether you like the podcast, if you have ideas for us, If there's something you think we can do better, like we're new to this process. Again, we're the amateur investors. So by definition, we're not professional. We're trying to give everyone free content, free resources to be the best investor that they can. So we want to hear your feedback. So yeah, guys, thanks for watching, for listening. We're excited for next week.
Yeah. Have a good one, guys. Thank you.